The global stock sell-off deepens as President Trump indicates that tariffs are here to stay. China discusses front-loading stimulus measures to counter the impact of tariffs as Asian equities tumble across the board. Plus, EU trade ministers seek to narrow their differences as they meet to discuss the response to the tariffs. So there is quite a lot going on. Monday morning, many market moves. Happy Monday, everyone. Now, the carnage in financial markets unleashed by the tariffs of President Donald Trump continuing unabated. Equities getting pummeled. U.S. stock futures, if we look at those, showing that last week's $5 trillion wipeout doesn't seem over. Now, S&P futures pointing to a loss of about 5%, 4.4% when Wall Street starts trading. Treasuries rallying. I'm looking at the 10-year yield to around 3.9%. So definitely a lot going on when you look at the European markets map. We're also getting a lot of equities being battered. And then if you look at fixed income, Treasuries rallying, definitely pushing the 10-year yield not only to 3.9%, but look, if you look from Shanghai to London, investors bailing on any kind of risky assets. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump and his economic team have dismissed investors' fears of inflation and recession, offering no apologies for the market turmoil sparked by sweeping global tariffs.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world.
Let's bring in Bloomberg's Rosalind Matheson, Lucy Baldwin, Global Head of Research at Citi, and Reid, Partner at Actum. So we have the A-team to try and figure out what happens next. First of all, Rosalind, we'll get to markets in a second. But, I mean, Donald Trump was pretty defiant yesterday, speaking to reporters on Air Force One and in other places. I mean, he seems to have dashed any hope of a quick U-turn, basically saying forget the markets for a second. Is there any way, this is a man-made problem, is there any way that he, unwinds it, or will he double down?
Well, what's the off-ramp? I mean, he has essentially campaigned on this. This is part of his ethos as president. So how do you walk this back or sand it down without looking like you've given too much ground away? And you heard him this morning. He was talking about saying this is part of the medicine of the recalibration that has to go on in his mind for US markets, US economy and the global economy and the global trading system with it. So he's saying this needs to wash through. He seems to be, like his officials, dismissing the market moves as something that's just part of the washout from these policies and sit tight and we'll all be okay. The question is, at what point does he realise he needs to do something? Is he willing to? He is a businessman. He is a negotiator. He does do a deal. But equally, he's bound so much of his agenda as president into this. Like, you can't walk too much of it back without being seen to give too much away.
Yeah, Lucy, you look at this carnage in financial markets, and at some point, someone, it must be that he's getting calls all the time. So there doesn't seem to be an end in sight for this market rout.
No, Francine, you're right. I mean, I think the challenge at the moment is the market is processing the downside risk to economic growth. And so banks like ours are out there busy cutting their forecasts. We kind of expected to see maybe another 3% year for global growth. Most people have taken anything from 1 to 2 percentage points off the US. We're certainly at the nearer 2% end of that range, which is sort of skating dangerously close to recessionary territory. Lots of markets around the world, including obviously Europe, probably faces about a percentage point downgrade from where we were to GDP. And you pull all of that together, you're probably wiping out most, if not more than all, of the 13% earnings growth you saw at the beginning of this year for US markets, and Europe had been expecting 7%. We've come out and said, look, we're looking pretty close to getting zero growth out of these markets from an EPS perspective. If you see the US going back into an earnings recessionary type environment, it's really hard even for markets like Europe, who might be relatively better placed to avoid catching that cold, as we know from old.
Yeah, I mean, Lucy, there's a million questions on actually, there's a chatter of a global recession, but also if you're the Fed right now, I don't know how you deal with it, because I know there's a big price pricing into cuts, but they probably have to hike and then cut to deal with inflation, then growth.
Well, the Fed has got the hardest job of all the central banks, right? I think the prescription, to your point, is clear in the rest of the world. You can aggressively cut into this because you're having such a bad growth shock and it's a deflationary impulse for everybody else. But for the Fed, to your point, we're expecting to see inflation go from previously expecting 2% to being more like 4% this year for CPI, for PCE. Now, that is a problem for the Fed. Now, our view is still actually that they will focus on the growth problem, right? And so we think they're going to cut. Now, markets are already suggesting 110 basis points of cuts from the Fed this year. We're at 125. So you can see that's why people are pushing into fixed income as an asset class. That sort of, where are the safe havens is another big question. We've just upgraded treasuries, so we've kind of gone long duration. And I think that's the natural response that we're going to see as this continues and people try and find a floor here and look for what is being described as either the Fed put or the Trump put.
And this is what Jay Powell said Friday on this.
I will say, though, it feels like we don't need to be in a hurry. It feels like we have time to. Yes, it feels like we don't. No, I mean, it's like I said, you have inflation is going to be moving up and growth is going to be slowing, but it isn't really. To me, it's not clear at this time what the appropriate path for monetary policy will be.
There's a number of wild rumors, including, Jay Powell was meant to be the fall guy when the markets were going to go down because he hadn't done enough on interest rates. Now, the buck stops firmly with the Trump administration. Do they not care about, the economy and markets?
This is classic Trump. Put the worst deal on the table and negotiate back. I think that we would come to appreciate the Fed chair because he's a steady hand that's really focused on market intelligence and facts. The Trump guys are really doing a gut thing. If you look at all the red on the wall, it tells you that perhaps they've gone the wrong direction. But I expect this to be 18 months full on. I expect him to get more aggressive as the market turns because he's using a gut. This is Donald Trump saying he is smarter than most people. He's not looking at market conditions. He's really saying this is my political gut. And when you have someone like the Fed who's looking purely at facts and information, we will come to appreciate the fact that we actually have checks and balances when a person is running an operation based upon facts or a person who's running an operation based upon his political gut.
But more so, on Friday, everyone was saying, well, where's the opposition? If markets continue doing something bad for longer term, the U.S. economy, people are not speaking up. I mean, people have started to speak up, even people quite close to him. What we heard from Stan Druckenmiller, we heard from Bill Ackman. Who does he listen to if he were to cool off or reverse?
Donald Trump listens to Donald Trump until he figures out a bad guy to take the fall. Right now, they haven't figured out a bad guy. He has a lot of people around him telling him what he wants to hear. Ultimately, this is why I believe this is going to be at least 18 months. There's going to be a lot of pain. It's going to be a lot of suffering. Donald Trump is going to have to look in the mirror and listen to really the type of allies around him that really understand the market, not just people that are politically close to him, but people that are his allies, that are employee people. But ultimately, this is going to come to politics. In 18 months, there's going to be a course correction, if you will. It's going to be a midterm election. That's ultimately. So people need to really get this fundamentally understand this. Yeah. This is not going to get better until there's a political opposition with teeth to push back. Right now, there isn't any. So this is going to be 18 months full on until the campaign starts.
I don't know if Lucy can take 18 months of this. What kind of economy are we left with if this lasts for 18 months?
Well, I think it is radically reshaped relative to what we were all expecting to see, isn't it? And I think, the way we've thought about this is that, you're seeing this massively negative impact to growth, an inflationary impact that's going to last. If these tariffs stay in, as we see, and the retaliation comes as is now expected, and so, that stagflationary pressure is going to be really significant for the US. And so that's why I think, our view here would be that you probably need to see this shift over to fixed income relative. That's what our asset allocation team is suggesting, hence the upgrade in treasuries. We upgraded bonds more recently. We took an underweight off that we had in Japan. So we can see that that's going to be an important part of what people will need to do to protect portfolios while we see where this floor can be in terms of equity markets. Our view on the S&P is that 4,700 seems to roughly calibrate the tariffs that are on the table. But of course, in addition to that, there's incremental pressure and risk if consumers and if corporates sit on their hands and say, gosh, we can't make any decisions, amidst all the turmoil. So that's the other piece.
But I think this is, to me, this is shocking. Why didn't people believe Donald Trump was going to do this? Why were they not prepared? He was clearly
because we thought he cared about the economy and he cared about markets.
Donald Trump cares about his political rhetoric. He started where he left off when he left office. He said the entire campaign he was going to do this. No one believed him. No one prepared. So now the economy, corporations are looking befuddled and they're like, I can't believe it. But this is exactly what he said he would do. And the fact that corporate America, the political class, did not prepare themselves for this, it's really shame on them.
Rose, do you think countries will retaliate? Because this is something, did Donald Trump think that countries would retaliate? Or did he think that they would just bow to his will?
Well, the only one retaliating so far is China, and China is retaliating in a proportional fashion, but quite deliberately. You can see that. And China has the means to retaliate because they've been prepping their economy for a while to be more self-sufficient. They've been diversifying their supply chains, their export markets as well. I mean, what they mostly send to the US is what's going to directly affect, to your point, the consumer. So it's going to have a direct hit there. What they buy from the US, they can probably absorb a little bit along the chain because it's commodities or materials, so it's not the finished product by and large. So they've got bandwidth, and they're being very strong in that. And it's very clear that Xi Jinping is not going to be talking or expecting to talk to Donald Trump anytime soon. But beyond that, to the point about whether he does change his mind, to use his slang, does he reverse ferret or does he partially reverse or sort of reverse ferret? Even if he does change on tariffs, the bigger, deeper issue is the relationships have fundamentally changed, and the relationship between the US and Europe, between US and allies, not just US and foes, but US and allies, long-standing friends in Asia and Europe, in the global south has fundamentally changed, and that goes well beyond just what happens with tariffs. It goes to the relationships around trade, investment, geopolitics, security, conflict, and more. The US cuts to US aid in Africa and so on. These things all affect US soft power around the world. So you're seeing a much deeper recalibration of these relationships and, dare I say, the global order than just what he does in the minute on tariffs.
But listen, Donald Trump only respects power and money. You see China moving fast because they were prepared and they have power. They're counterpunching. When you don't have leverage with Donald Trump, the best thing to do is cut a deal as quickly as possible so he can declare victory, he can move on, your economy, your business becomes stable. Look at what the law firms did, right? So the only two things he respects, and when you understand this, you understand how to engage with him. So corporate America, why you see people running to him doing deals, they think it's going to ultimately save them. It's not if they don't have real power and leverage with him. He's looking at ticking a box. He's just counting trillions and trillions of deals, not necessarily who he's doing deals with. It's a scorecard for him. It's really about power and money. China is playing it precisely the right way. Europe is moving too slow. They need to get in the game, and they need to start counterport. The problem with Europe is they're not coordinated. That's the real challenge for Europe.
Which he's probably also trying to, if not break up, certainly test.
Yeah, certainly. I mean, you saw Vietnam, for example. They went straight to zero tariffs, and that's had no impact. It'll be interesting to see the Israeli leader, Benjamin Netanyahu, going to the White House today, meeting with Trump, and mostly on tariffs, a little bit of Gaza, but mostly on tariffs. And what does that look like when you get right in front of him and you're someone who's known him for a long time? Do you have leverage there? I mean, to your point about Europe, it'd be very interesting to see the EU trade ministers meeting today, because there is already a range of opinions in Europe. It's mostly about let's sit a little bit and wait. France pushing heavily for a strong response, including to come for US big tech. Asymmetrical responses, including the tech sector. France pushing that, Germany pushing a strong response. Other nations in Europe saying, we're a little bit unsure here what to do. And so that question of unity is really important.
So what does that mean for gold, but also longer term? Is the U.S. no longer going to be a reserve currency for the world?
Well, I think that the question mark that a lot of people have right now is on this concept of the U.S. dollar smile, right? That the dollar does well when times are good, but it's also the safe haven when things are going badly. And is that broken? Is the left-hand side of that dollar smile broken? And reaction since Liberation Day has suggested that there's some real risks to that, right? And I think, that's why, relatively speaking, you might see the euro doing a bit better than the dollar, because, relatively speaking, things look a little bit better. And I think the question mark is going to be somewhere like China, where you've got the power of stimulus that you could unleash, and we're expecting to see that happen, and you can mitigate some of the effects. But it then becomes much more of a relative game in a world where you are seeing, in aggregate, quite a big compression to global demand.
Can I just quickly respond? Netanyahu will get nothing. He has no leverage and no power with Donald Trump. He will come there. He will come out with nothing. The best thing he can do is look for his political survival. That's number one to him, his political survival, not the economy. With regard to Europe, they should have the Prime Minister of Italy negotiating on their behalf. Get rid of all these trade things. She has a relationship with him. She should be the point person dealing with him. And this is where they fundamentally still don't get it. He wants to deal with people that he likes and respects and appreciates. Germany's not there. France is not there. If I were them, I would push them forward. But most importantly, if you really want to hit America where it hurts, go after these professional services thing. When you start putting VAT there, that's real pain, because that's lots and lots of people. And that's really what America is, a service economy now. We have to wake up to the reality of what the country is and where the economy is moving.
Yeah, and I don't know whether the Italian Prime Minister would actually agree to do that job. It's a good point. Thank you all for joining us. Ross Matheson, of course, our EMEA News Director, Lucy Baldwin, Global Head of Research at Citi, and Norris Reid, Partner at Actum. Coming up, Russia demanding sanctions relief as part of the ceasefire in Ukraine. The European Union is standing firm. We hear from the EU Sanctions Envoy, David O'Sullivan. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the Spanish economy minister says the European Union needs to be open to all potential means of retaliation against U.S. tariffs. Now, this comes as EU trade ministers meet in Luxembourg today to hash out a unified response to the looming threat. Let's go straight over to Bloomberg's Oliver Crook, who's there. Ollie, what else what's the option actually for a lot of these ministers?
Yeah, well, I think that's the big question, Francine, and really for the trade ministers that are assembled here in Luxembourg, it's for them to really come together and have a unified response for the first time since we got those tariffs declared last week. They will go into force at 20% on April the 9th, and we've had a very different set of opinions from a number of different people. We heard from Emmanuel Macron, as you'll recall, last week, basically telling all European companies to pause their investments in the United States. We had the German economy minister, Robert Habeck, who just walked in just moments ago, saying that basically what Trump has done with tariffs, he likened it to the invasion of Ukraine, and that basically the Europeans need to have as strong a response to that as they did to Russia. We have heard, however, from the Italians a little bit taking a slightly more diplomatic route during this, saying basically everyone should be keeping a level head. We also heard from the Spanish economy minister, whom I spoke to just about an hour and a half ago. Have a listen to what he told me.
We have to somehow avoid taking out of the table any instrument. We have the proper tools, the necessary tools to respond. So none of them should be discarded at this point, but we need to keep on sending a message of being open to negotiating with the US, but we need them also to be able to negotiate. We need two to tango.
So as far as the European Union is concerned, they would prefer to have a negotiated deal. We've known that from the beginning. We've heard that from Ursula von der Leyen. But hearing Donald Trump over the weekend, hearing Scott Bessent, hearing Howard Lutnick, I'm not sure that this is an American administration that is too pressed to come up with the deal at this stage. And, of course, with all these different member states, all of them have different interests. Some of them are going to be, yes, very concerned with the issue of trade. Others are going to want to keep the U.S. on side for issues like Russia and Ukraine.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, on this trade ministers' conversations in Luxembourg. Now, fresh talks between Russia and the U.S. towards a ceasefire in Ukraine are expected as soon as this week. This from the Kremlin's negotiator. Now, Moscow has been pushing for sanctions relief as part of any deal, but the European Union has indicated it's willing to ratchet up its sanctions on Russia. For more, we're joined by the European Union sanction envoy, David O'Sullivan. Mr. O'Sullivan, thank you for joining us. Now, as we were just saying, Russia demanding sanctions, easing as part of the ceasefire negotiations. The EU has ruled it out and is working on more sanctions. Is there a scenario where the EU would actually consider sanctions easing?
Well, I think, first of all, the most important thing to understand is that after 3 years of the most massive sanctions which we've ever imposed on any country, the Russian economy is hurting. That is why I think Mr. Putin is seeking sanctions relief as part of these discussions. The view of the European Union is that this is a very important point of leverage in any negotiation with Russia, and it should be used, but used very judiciously and slowly, and only in the context of arriving at a solution which is lasting and sustainable peace, as President von der Leyen said a couple of weeks ago. So, yes, I mean, at some point, sanctions relief would become part of the discussion, but we are very nervous about any suggestion that this could happen prematurely or in the context of a purely temporary arrangement.
Has the U.S. reached out to the EU to participate in the negotiations, at least on sanctions?
Well, as you know, this is an issue of some discontent on the European side. I mean, I think many people feel it would have been better to involve more closely the Europeans and indeed the Ukrainians in these negotiations. The US has chosen a different method. We have not yet had any discussions with the Americans, to my knowledge, about the issue of sanctions. And even when Russia did seem to impose, to suggest some conditions of lifting of European sanctions in the context of the Black Sea possible ceasefire, to my knowledge, there was no reach out from the US to ask the Europeans to concede to that, and the European view was that we would not concede to any such a request.
It's our understanding that Europe is not involved in talks so far, but are there any conversations behind the scenes with the US? Have there been any contact?
Our contacts are relatively limited because, to be quite honest with you, many of the people with whom we worked on sanctions in the previous administration have left, as is the normal practice in the US, and many of those positions have not yet been filled. So we are still waiting to have the full set of interlocutors that we have normally on sanctions, and these posts are not yet filled.
Okay, what can you tell us about the 17 sanction package in the works? So what kind of timeline and the size and scope of this package that you're looking at?
Well, I think what's really important, Francine, at this point is that there probably will be a 17 package. There'll probably be an 18 package, I fear. After the 16 packages, I mean, we have in place the most comprehensive set of sanctions against Russia that we've ever had against any country. We used to trade some 260 billion a year with Russia. We now trade 60 billion. So we've cut our trade by nearly 75%. We have sanctions on 7,500 products. We have sanctions covering most of our financial transactions. We have immobilized 300 billion euro of central bank assets in Europe, and we have frozen some 28 billion assets belonging to oligarchs. So we've already done a lot. We've almost completely eliminated our dependence on Russian coal, on Russian oil, and we are in the process of finally squeezing out the relatively small dependence we still have on liquid natural gas. So, I mean, any new packages will, by definition, be incremental, be adding to this already massive range of sanctions. Clearly, we continue to be concerned about the energy field. There is more work to be done there to finally eliminate any dependence on Russian energy. We're concerned about the shadow fleet and Russia's attempts to evade the oil price cap. And, of course, there are always additional sectoral measures that might be considered here or there where we discover loopholes or areas which we'd like to see better covered, such as fertilizers, where we're acting through tariffs rather than through sanctions, but with the same objective.
Mr. Sullivan, can I ask you, I know there's been a lot of turmoil in the last 5 days because of the tariffs announced by the U.S. Does that mean that it's less likely that the EU, if they stay under continued pressure like this for 10, 15, 18 months, will make the relationship with Russia change, that there's less appetite for some of the sanctions put in place because they're reeling from the U.S. tariffs?
No, I think we have put the tariffs in place we have put the sanctions in place because of Russia's unprovoked full-scale invasion of Ukraine and the conduct of an appalling war by Russia on the territory of Ukraine. That we will only lift those sanctions when that situation is relieved or stopped. The sanctions are linked to Russia's aggression in Ukraine. They weren't an economic decision. They were not a decision of economic protectionism or anything else. They were to punish Russia for the unprovoked aggression in Ukraine. And as long as that aggression continues, and as long as there is not a sustainable and convincing peace arrangement, I believe those sanctions will stay and may even be increased.
Yep. Thank you so much for joining us. David O'Sullivan there, the EU sanctions envoy. Now, coming up, as the gaming industry also weighs the impact of the global tariffs, we take a look at what the future holds for the sector with Ian Livingstone. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. European stocks trimmed some of their declines along with U.S. equity futures, but the sell-off is far from over. Well, this comes as President Donald Trump indicates that tariffs are here to stay. China discusses front-loading stimulus measures to counter the impact of tariffs as Asian equities tumble across the board. Plus, EU trade ministers seek to narrow their differences as they meet to discuss their response to the tariffs. So Bloomberg has learned that China's policymakers discussed measures over the weekend to stabilize the economy and markets in the face of Donald Trump's tariffs onslaught. Sources say this includes whether to accelerate plans to unleash stimulus to bolster consumption. Well, Chinese stocks sank this morning as the global rout continues. So let's bring in Ellen Wong, who leads Bloomberg's China government and economy coverage, as well as our global trade czar, who hasn't slept a wink in about a week, Brendan Murray. So thank you both for joining us. Alan, how has China responded to Trump's tariffs? They seem to be the only nation really pushing back.
That's correct. China this time hit back quite fast and strong, imposing the same 34% tariff rate on all U.S. products entering the country. And on top of that, it also put 7 more rare earth minerals into its export control list. So those minerals are used in all sorts of high-tech applications, including in the defense sector. So China this time around really showed that we wanted to match the U.S. strength in imposing these tariffs and other trade measures.
Brendan, I was surprised. I mean, the president definitely doubled down, right, yesterday. I mean, you know, I would have thought that with the global market rout that we saw on Friday, and actually I think the markets lost them $5 trillion last week, he would kind of pause. But yesterday he basically said, stop thinking about the markets for 2 hot seconds.
Exactly. And he had his, his top economic officials out, saying the same thing, basically. I think, we heard President Trump many times say that trade wars are good and easy to win. And I think what we're seeing from the financial markets perspective is trade wars are hard and they aren't easy to win. China, as Alan mentioned, hit back at those rare earth minerals. That will really hurt American companies that are, making batteries and high-tech medical devices. That will really leave a mark on the innovative side of the economy, and we'll have to see what Europe does now. Does Europe throw fuel on the fire, or do they let this burn on its own?
Alan, how much more aggressive can China be? And actually, if you look at the Chinese market reaction today, what does it tell us?
Well, the Chinese market reaction tells us that people are panic selling. In terms of China's countermeasures to U.S. measures, I think that's about it for now. But the tariffs haven't kicked in yet, so there's still room for either side to do more or pull back. It's noteworthy that China has already imposed those tariffs on all U.S. imports. And based on the current tariffs already announced, that our economists expect trade between the two countries to basically slow to a halt. So what more can China do in this regard? It remains to be seen. But what we've also seen from China is that they've signaled to the domestic audience that it's digging in. In the front page editorial in the People's Daily, party mouthpiece, China said that don't panic and we've got your back, basically promising to support the domestic economy by stimulating consumption. It also floated previously mentioned measures such as cutting rates and lowering the reserve requirements for banks to support lending. All those measures, they are more likely now because of the market reaction and also because of potential weakness in the economy because of the hit to China's exports.
Yeah, interesting. And Brendan, I was also having a conversation with Ban Boej of UBS, and China can't change their business model on a dime. So if they can't export to the U.S., they'll probably export to other countries, and then they will be tariffed more from the U.S. So it's a lose-lose situation.
Yeah, absolutely. And I think you can see President Xi Jinping reaching out to countries in South Asia to try to shore up some of those relationships. Countries like Vietnam, Malaysia, where the U.S. The higher tariffs kick in on Wednesday, and as Alan mentioned, there's a very short window for that to happen. So we'll have to see if another day of a punishing market response turns the attitude in the White House. We heard Elon Musk over the weekend talking about a free trade zone between the U.S. and Europe. So perhaps some of those voices will get louder and louder and somehow stop those tariffs from taking effect. But it doesn't look like it at the moment.
Brendan, I mean, do you have a good understanding? Because I've been glued, all weekend with the equation, and of course there are memes, and it's quite funny that the penguins got tariffs and tax. But at the end of the day, who does President Trump listen to? Is it just himself because he's held this belief for a long time? Is it Peter Navarro? Is it someone else?
It sounds like the sort of more hawkish wing of the economic team that he's listening to. Howard Lutnick, Scott Bessent. He was also on the airwaves yesterday. Look, at the end of the day, Liberation Day is going to turn into litigation day. The courts are really the only thing that look like they have a chance of stopping this. A challenge to companies will challenge the authority that he's used to impose these tariffs, and that we could see a whole new kind of fight through the courts.
Okay, thank you both for joining us, Alan Wong and Brendan Murray. Now, Bloomberg has also learned that President Trump was close to an agreement with ByteDance over TikTok's ban in the U.S., but the deal stalled over China's objections to the latest tariffs. Now, on Friday, President Trump extended the deadline for the sale of TikTok's U.S. operations for another 75 days. ByteDance says any agreement would need to be approved under Chinese law. Now, the gaming industry is weighing the impact of President Trump's global tariffs. On Friday, Nintendo said it's delaying pre-orders for the new Switch 2 in the U.S. Now, there are fears that tariffs could deal a blow to the sector as video game components are sourced from multiple countries. The industry has had a challenging 2 years with thousands of job losses, studios shutting down, and big games failing to deliver. Well, lots to discuss with Ian Livingstone. He's general partner at Hiro Capital and co-founder of Games Workshop and EDOS, the companies behind Tomb Raider and Warhammer. Sir Livingstone, thank you so much for joining us. I mean, you're a legend in the gaming industry. You started decades ago with a lot of success. Did you ever think, first of all, that gaming would get so big so quickly?
Well, we started Games Workshop in January 1975 and had to sleep in a van for 3 months because we couldn't raise any finance at all. All we had was passion and idea and an understanding that people enjoy play, but there weren't enough games around for grown-ups, as it were. But never in our minds did we think it'd become a multi-billion-dollar-a-year industry. I mean, the video games industry itself is worth $250 billion a year. You see Games Workshop, although I'm no longer associated with the company, enter the FTSE 100, worth some £4.5 billion. These are extraordinary numbers, and nobody would have projected that. But the games industry has gone through a cyclical change in the past with hardware platforms coming and going, but this has been deeper than usual, and obviously the impact of tariffs is going to be significant, but only for hardware. So physical goods are going to have tariffs on them, but games are largely seen as a service. They run as a service on digital platforms, therefore tariffs shouldn't apply.
Are the two linked, though? If the hardware gets hit, then there's likely to be less innovation in terms of games for the software. And
well, obviously there's a delay in the Switch 2, but there are other platforms and PCs and the other digital consoles and smartphones, etc. So they will continue to flourish, and I think it'll only be a matter of time before the Switch 2.
I know the table version of Warhammer is widely seen as UK manufacturing success story at a time when there's so much pressure on so many companies to bring manufacturing back to our countries, including the UK. What can we learn from Games Workshop?
You have to find your audience. I mean, the Games Workshop experience really hasn't changed in those 50 years. It's making games for like-minded people. when we started off, when we opened our first stores, we didn't hire traditional retailers from high street stores. We employed people like us. So they might have looked like Visigoths, but they're hugely specialists in their knowledge, and that knowledge of products, how to paint figures, how to explain the rules, made people feel very comfortable, and they ended up spending a lot of money inside the shops because they were talking with friends. So that experience, I think you have to really understand your audience, and in video games in particular, you have to build a community around them. So if you're seeing more and more developers working through Discord and other community-based software platforms to engage with an audience, to get buy-in and support and love for the products that they're creating.
I mean, when you look at lucrative markets or lucrative lines of business, I know, for example, for Warhammer, there's quite a lot with Space Marine 2 and a planned show on Amazon. Does gaming and kind of streaming or even shows on platforms such as Amazon the next frontier?
Well, it's everyone's talking about transmedia in games, and there's obviously been a connection with the silver screen. I mean, there's been lots of games licensed over time. I mean, we licensed Tomb Raider way back, some 20-odd years ago, to Paramount, and it was a great success. And you've seen recently with HBO doing a fantastic job of translating a video game, The Last of Us, onto TV series that really respected the audience. So I think it's understanding the audience, that the games industry and the games audiences are, they're very passionate about their hobby and passionate about the games they play. So you have to respect that IP.
What do you think is the current state of the video gaming industry?
It's going through a transition, but the economic headwinds will pass, and it will continue to grow. I mean, games help define us of who we are as human beings, and Generation Z, Generation Alpha, prolific use of social media, everything they do is interactive, they share everything, and obviously games speak to that way of behavior. So they want to have agency, they want to have control, they want to meet and play and be with friends online in gaming environments.
I mean, Eidos, I know, is one of the best-known video game publishers, right, in its time.
Yeah.
Why has the UK not been able to replicate such a success story?
Well, we had incredible intellectual property, and it's kind of, for me, a little bit disappointing and almost sad that games like Tomb Raider, Grand Theft Auto, Football Manager, Golf Clash, Fall Guys, and many others, global success stories, are now foreign-owned. I think it's not our ability not to be able to scale and have enough capital available to be able to give the IP creators a further ownership of the value up the value chain without having to sell out too soon. So that access to capital, I think, is paramount, because the government might say, well, it's great because you get inward investment and job security, but if the taxable income is being taxed overseas, we become a work for hire nation, which can't be good in the long term.
So how do you fix that?
Well, get the makers and the money to understand each other's worlds a little bit better. You see huge amounts of capital coming from the United States, from China, from Japan into the games industry, and they own all our blockbusters now. Yeah. So we must have greater faith and an understanding that games are here to stay. It's an incredible market, and let's play.
We spent a long time figuring out what AI means for this industry and that industry. What does it mean for gaming?
I think it should be seen in the short term definitely as a tool. It should be seen as positive, but it can never replace human creativity, to my mind. That unique creativity that we have as human beings is irreplaceable. All it can do is aggregate historic content that's already out there. So it should be seen for procedurally generated content, maybe self-generating games at some point. As long as it doesn't replace the human condition of creativity in games, we should all benefit.
Is there a danger that it could actually, or that it brings new entrants really on the cheap, so that the industry...
Well, if games become self-generating through AI, then obviously that's going to have an impact on jobs. But if it's seen as a tool and respect intellectual property, I'm sure the lawyers are going to have fun in the future with AI. I hope it can be used in a very positive way.
Sir Ian Livingstone, thank you so much for joining us.
My pleasure.
We need to make this a regular interview.
I'd love
I know
to.
There's a lot of gamers
I could talk about games all
watching
day.
us. General partner at Hiro Capital and co-founder of Games Workshop and EDOS. Now, in the meantime, we go back to tariffs, and Nouriel Roubini has warned that if President Trump does not dial back on tariffs, the U.S. will face a recession. Now, the chief executive of Roubini Macro Associates has told Bloomberg that if Trump does not de-escalate, there'll be a full-blown trade war with China.
Well, it's a game of chicken between Trump on one side, Powell at the Fed on the other, and Xi Jinping on who's going to be blinking first. You know, Trump is trying to nudge Powell to blink and his monetary policy as a way to push markets higher. But Powell knows that given what happened on April 2nd, if he blinks, there'll be a de-anchoring of inflation expectation, and those tariffs are going to lead to higher inflation. So he's not going to blink. Of course, there is a Powell put, there is a Trump put. But Powell, I don't think he cares as much about the stock market. He cares about high yields. Because if high yield spreads were to widen a lot, that's a true sign we're going to go into a recession. This past week, high yield spreads have gone up only 100 basis points. That's not yet a distressed point of view. The point about the Trump put that he doesn't care anymore about the stock market, and he believes that actually long rates have gone lower, the dollar is even a bit lower, maybe that's an easing of financial condition, so he doesn't want to blink. And when it comes to Xi Jinping, there's the beginning of this game of chicken between Trump and Xi Jinping. We started with attacking them, they retaliated, we may retaliate, they're going to retaliate. That's going to lead to a full-scale trade war. I think that Xi Jinping has more leverage. He doesn't face an election next year. He can use monetary policy, fiscal policy, and currency policy, and structural policy to strengthen domestic demand. And he's not going to give a Xi put a signal he's going to start to negotiate until Trump is really serious about de-escalating. But it looks like Trump doesn't want to de-escalate with China because he wants to corner China and to lead to a radical reduction of the trade imbalance between U.S. and China. Now, in this game of chicken, I think that we end up actually that the rational thing to do for Trump will be to de-escalate, because if he doesn't, there is for sure a recession. If there is a recession, he loses the midterms, and then he's politically gone.
Well, that's Roubini Macro Associates Chief Executive Nouriel Roubini speaking to Bloomberg. Coming up, traders price in 5 Fed cuts as U.S. recession fears mount. More on the market fallout from President Trump's tariffs. Coming up, this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, stock markets are tumbling this morning as traders rush to havens. Let's assess the overall reaction to U.S. tariffs. Bloomberg's MLive strategist, Ven Ram, joins us from Dubai. With me here in the studio, Bloomberg's Charlie Wells and our global autos editor, Craig Trudell. We have team coverage. So, Ven, markets pricing in 5 rate cuts from the Fed this year. Is the market just overdoing the dovish bets?
It's hard to say that, Francine, because I think that the markets have all characteristically been overpricing what the Fed, how much the Fed will cut. But I think in this one instance, I think they are not wrong to bake in the kind of rate cuts they are doing. Why do I say that? Because the economy is going to go into a tailspin because of what Trump has meant on tariffs. And I think that the longer the tariffs continue, the worse it will be the real outcomes will be for the economy. And I think that it means that a shrinkage of trade and corporate earnings and all that. So if you assume a 30 to 40% decline in earnings rate, that's severe. That puts us back in a depression kind of era. And nobody wants that, but that's what will happen if Trump persists with tariffs. And in that scenario, the Fed will come out and cut rates. Back in 2020, during the pandemic, the Fed came out in March to cut rates first by 50 basis points and then by 100 basis points, 150 basis points, both in emergency settings. And that is what the markets are fearing. And therefore, the markets are not wrong to factor in the rate cuts that they are factoring. If the tariffs persist, this is what will happen.
Yeah, and of course, many also betting on an emergency reduction. Charlie, you're looking at the financials for us and actually have two big billionaires. One, Bill Ackman, who's also a real backer of Donald Trump, suddenly saying, like, look, this is not a great idea. I don't know whether that's enough to do, for the president to do a U-turn.
I mean, Francine, the question had been, when would these billionaires start kind of showing dissent? And that certainly has started. And I think with Bill Ackman, he talked about how this was a mistake in a post on social media over the weekend. He called about how the president needs a 90-day pause here to let cooler heads prevail. And I think some of his words here are really fighting. He talked about how, quote, the president has an opportunity on Monday to call a timeout and have the time to execute on fixing an unfair tariff system. Alternatively, we are headed for a self-inflicted economic nuclear winter. So those are some of the strongest words that we've heard so far, and they're notable coming from a backer.
And Craig, so you're looking, of course, at the autos industry. How chaotic has their response been to these tariffs?
It's really been all over the place. So we've seen Ford and Stellantis come out with these really aggressive deals. I think that may be an indication of their having quite a bit of inventory on their lots, more so than a signal that they're going to be able to sort of rise above all this. And a sort of an attempt on their part to keep the consumer sort of at ease and reassure them in these turbulent times. On the other hand, you have Hyundai, saying we're going to keep prices steady for a certain amount of time. You have Volkswagen taking the sort of 180-degree different, move here and saying they're going to actually put import fees on the sticker of their vehicle. So it's really all over the place what we're seeing manufacturers doing.
And then, Craig, Jaguar Land Rover also pausing exports to the U.S. This feels significant.
This is a huge deal for the UK auto industry, which is already in sort of a world of hurt of late. JLR is sort of neck and neck with Nissan as the biggest manufacturer in the UK. For them to sort of lose access to what is their biggest market in the world in North America, the U.S. being the biggest part of that is massive for them. And there's a real question of how long can they, sort of allow for the fact that that's just been wiped off the table.
Yeah, Yvette, so we're looking at real businesses kind of having to deal with it. What's your expectations for Treasury yields? Where do they go from here?
Well, I think that to the extent that the markets are going to price in further rate cuts, I think that Treasury yields will fall from here. I think that the two-year yield has potential to fall all the way back to 3%. That's assuming 6 rate cuts from the Fed is possible if you assume the worst of the Trump tariffs fallout. And that will mean a 10-year yield of 350. But those are kind of the extreme tail of the scenarios we are talking about. That's not the kind of central scenario, but the central scenario assumes that the Fed is going to the White House is going to roll back some of the measures, or at least put on hold some of the measures for the time being.
Then stocks are also really, really slammed. So what would it take to stop that slide?
Well, it's going to take a lot. I mean, they are going to have to revoke and walk back some of the measures or put them on hold, as we just discussed. Because if you look at the earnings yield, aggregate earnings on the S&P, Francine, it was about $240 at the end of 2024. If you assume that this is going to crimp corporate earnings by 30 to 40%, we are talking about an EPS of about $150. And if you use the median PE on the S&P, which is about 17.8, you will arrive at a fair value of about 2,500 on the S&P. We are at 5,000 plus, so that means that we are only halfway there, which means that the declines are further to go.
Yeah, Vanna, I mean, this is impacting kind of like all walks of the market, including Charlie M&A. How many deals have been taken off the table?
Francine, it's billions of dollars of deals, and this was a disappointing year, and it's becoming even more so. So on the IPO front, we're seeing some of the most hotly anticipated IPOs put on pause. I'm talking about Klarna. I'm talking about StubHub. I'm talking about eToro. eToro's roadshow was scheduled for this week, and that's been put on pause. On the M&A front, you've got a number of big names to the tune of billions of euros here in Europe. Sanctions Saint-Gobain, the French building materials company, they have paused a sale of their auto glass maker, and that could have fetched as much as 2.5 billion euros. You've got Gerresheimer, the German packaging goods company. KKR walked away from a consortium that was considering a takeover. Again, 2.5 billion euros that could have been, that was the market value there.
And Craig, I mean, a lot of companies or a lot of banks are revising down their earnings per share forecast and trying to remodel this. Unclear how they do it, given we don't know where tariffs end up. But I think car makers have it the worst because they were already struggling before any of this announcement.
Yeah, I think you had a lot of manufacturers that were really having challenges with the electric vehicle transition. All of the investment they were putting into that, only for the momentum toward EVs really slowing dramatically. And so here in Europe, you have companies now that rely on the U.S. for a substantial portion of their earnings, and we're talking about, if this level of tariff stays in place, huge blow in the side of their operations in the months to come.
Okay, thank you all for joining us. We have full team coverage. Venram, of course, Charlie Wells, and Craig Trudell. Traders, once again, boosting actually their expectations for the Fed interest rate cuts this year, as a lot of these tariffs really ignite fear on the markets, and we're clearly seeing a very big risk-off mood. Actually, markets increasingly betting on a possible emergency reduction as well. Now, the Democratic Senator Elizabeth Warren is on balance of power later today. Catch that conversation at 9:30 p.m. London time. Up next, Bloomberg Brief, and this is Bloomberg.